Welcome to this tutorial. I'll be solving the question on right issue. And the question is ICAN November 2021, question number 3. November 2021, question 3. Before I go further, I want to make one or two explanation. But if you have not watched my previous video on the right issue, introduction to right issue, please do well to watch that video. So right issue basically has to do with issuing of share to existing shareholder on a pro rata basis below the market price of the share. So in your examination, your examiner will decide to give you, let's assume that the current share price, is 20 naira. The examiner could tell you that the right issue will be issued at the price of 15 naira. If this is the case, you know that these shares are issued below the market price of 20 naira, and it is a right issue. The examiner also would decide not to give you 15 naira as the right issue price. The examiner may decide to give you information that you can use to determine what the right issue price may be. In this scenario, your examiner may tell you that the share price is currently 20 naira, but the company will issue a right issue at the market price, below the market price rather, say at a discount of 10%. If that is the case, how do you determine the right issue price? At a discount of 10%, it means the right issue price will be 20 naira times 90%, which will give you 18 naira, if that is the case. The third way your examiner will want you to get the right issue price may be that the company needs to carry out an investment. Assuming a company has an investment of, say, 50 million naira, and you are told that the company will need to issue 60, or let me just say 10,000 right issue share to finance this 50,000 naira investments. So how much will the right issue, or will the share be issued? The right issue offer share will now be 50 million over 10 million, and that will give you, or 50,000 over 10,000 rather, and that will give you 5 naira per share. So in this scenario, the examiner has given you the investment that will be needed. The examiner may not give you directly that it is 10,000 shares that will be needed, but the examiner will give you existing shares. Let's assume that existing shares is 50,000. And the examiner may tell you that it's a 1-for-5 right issue, so times 1/5. So that will give you the number of shares that is expected to be offered as right issue. So if the existing share is 50,000 and is a 1-for-5, so 1/5, that gives you 10,000 shares. And if the company wants to raise 50 million, it means that they are going to raise the 50 million, selling 10,000 shares, and the value per share will be 5 naira. So let's look at this question. XZY PLC is an all equity financed, and a listed company which operates in the food processing industry. The XZ family owns 40% of the ordinary shares. So this family, if a particular family has 40%, so that means if it is only two group of people that has a share, they have 40, another have 60. We say they don't have control, but at least they have significant influence. But if this 60 is held by different set of people, that means they will definitely have the majority shareholding in this company. The remainder are held by large, look at it, the remainder are held by large financial institutions. So the remainder is held by different institutions, but they are large financial institutions. There are 10 million ₦1 ordinary shares currently in issue. So the current number of shares in issue is 1 million ordinary share. The company has just finished a long-term contract to supply a large chain of restaurants with a variety of food products. The contract requires investments in a new machinery costing 24 million. Sorry, let me take this again. The company has just finalized a long-term contract to supply a large chain of restaurants with a variety of food products. The contract requires investment in a machinery costing 24 million. 24 million. So you remember that your rights issue is also a way of financing a project or a way a company raise finance. The machinery will become operational on 1 January 2022, and payments will be made on the same dates. Sales will commence immediately thereafter. The company policy is to pay out all profits as dividend. If XYZ as dividend, and if XYZ PLC continue to be all equity finance, there will be annual dividend of 9 million in perpetuity commencing 31 December 2022. So that means the projected dividend payment will be 9 million naira. And if the company is paying out all profit as dividend, it means that the profits will be 9 million naira also. There are two alternatives being considered to finance the required investment of 24 million. There are two alternatives. Let's look at the alternatives. Alternative 1. A 2-for-5 rights issue. A 2-for-5. So this 2-for-5 is the ratio, is a rights issue ratio, in which case the annual dividend will be 9 million. The cum right price per share will be 660. So the cum right price means the share price before the right issue. Cum right price is the share price before the right issue. That's the first alternative. The second, alternative 2, issuing 7.5% irredeemable bonds at par with interest payable annually in arrears. For this alternative, interest will be paid out of the 9 million otherwise available to pay dividend. So if the company financed the project by borrowing, the company cannot pay dividend of 9 million because the company will need to pay finance cost of 7.5 million on the 24 million investments or borrowed to finance the project. For either alternative, the director expects the cost of equity to remain at its present level of 10%. Okay, so this negates the capital structure proposition, the M&M, which assume that the cost of equity will continue to increase as sharing increases in order to keep cost of debt constant. Okay, but here your examiner is telling you that the cost of equity will remain constant, whether it is debt finance or it is the company is financed by debt and equity. So you go with what your examiner has given you and you work with that. Let's look at let's continue. Required. So what is the requirement? A, calculate the issue and X rights share price. So the issue price here now, we're not giving the right issue price. So you need to calculate the right issue price as the first. Then the second, the X right price is the theoretical X right price. Assuming a 2 for 5 rights issue. The second, calculate the value per ordinary share in XYZ PLC at 1 January 2022 if 7.5% irredeemable bonds are used to finance the projects, assume the cost of equity remain constant. So you are asked to calculate the value of the ordinary share. So under your market for your, what's it called, business valuation. Under your business valuation, there are different methods that can be used to value a company. So in this scenario, the examiner did not give you a specific method to use to value the company, but you are asked to calculate the value of the company after the rights issue. Okay, let's go back to the question requirement A. So back to requirements A. So now this is a 2 for 5 right issue. How many shares does the company currently have? So we need to first of all determine how many shares will be issued. How many shares does the company have? We can see that here. The company has 10 million ₦1 ordinary share. So if that is the case, with a 2 for 5 right issue, how many new shares will be issued? So the new shares that will be issued will be 2 all over 5 times 10 million times 10 million, that's 10 million over 1. So this is 1 and this is 2. So that will give 4 million new shares. 4 million new shares. But what is your examiner asking you to calculate? Calculate the issue, and that's the issue share, that's the right issue price. So right issue price. So now we know the number of shares to be issued is 4 million new shares. And the company formerly had 10 million shares. So the total shares after the right issue will be 14 million. Let's go to the notes. So let's look at the right issue, the offer price. Creation of offered price. The amount required amount that is required is 24 million naira. But the offer ratio, the right ratio, is 2 is to 5. A 2 for 5. Sorry, that should be a 2 for 5. That's exchange ratio. So how many shares will be issued? The company currently has 10 million shares. So new shares will be equal to 10 million times 2 over 5. So this will give us 20 over 5. That's 4 million new shares. So how much will these shares be sold to raise 24 million? So 24. So the offer price will now be equal to 24 all over 4. So that will be 6 naira per share. 6 naira per share. So this is the offer price. So the next calculation, still under the first requirement, is the theoretical X right price. So theoretical X right price. How is that calculated? Company has the exchange ratio is 5 whole shares for 2 new shares. So after that, an investor that has 5 shares before the right issue, after the right issue, the investor will be having 7 shares. The old shares, what is the cost of the old shares? In the question, we're told that the share price, div, is 6 naira 60 kobo. So this become 6.6 times 5. That will give you the value of the old shares, 33 naira. The new shares will be issued at 6 naira. So 6 times 2. That gives 12 naira. So the total value for an investor that has 5 shares, the total value of the investor's investment after the rights issue will now be 45. Therefore, the theoretical X right price will be equal to 45 all over 7. This gives 6.4285, approximately 6.43. So 6 naira 43 kobo. This is requirement A. Let's go back to the question and look at the requirement B. So requirement B says calculate the value. Calculate the value per ordinary share in XYZ PLC on 1 January 2022 if 7.5% irredeemable bonds are issued to finance the new projects. Assume that cost of equity remains at 10% each year. Ignore taxation. So what do you think here? What do you think here? So basically, from your business valuation methods, you want to calculate the value of the company's share. And there are different ways that you can use to calculate the value of a company's share. You have the asset-based valuation method. You also have the income-based valuation method. So based on the information we have in this question, definitely we cannot use the asset base. So under the income base, we have the free cash flow. We have the free cash flow method. We have the dividend valuation method, the discounted dividend valuation method. We have the PE ratio valuation method. At times, the examiner may just decide to give you, say, a discounted cash flow. And the discounted cash flow, the parameter for determining the cash flow, the examiner will give you that parameter. Okay, but in this question, which of these 3 methods do you think we can use to value the company? So basically, it is the dividend valuation model. And how do you value a company using the dividend valuation model? The value of a company, okay, before will be, let me write this first, market value of equity D naught over KE if there is no growth. In this question, we're told, let me go back a little bit. So let's look at what dividends will be like in the coming years. Okay, so sales would commence immediately thereafter. The company policy is to pay out all profits as dividend. If XYZ PLC continue to be all equity finance, there will be annual dividend of 9 million in perpetuity. So 9 million in perpetuity, that means there's not going to be growth in dividend. It will be 9 million in perpetuity. So back to the requirements 2, say issue 7% redeemable bond at par where interest is payable annually. That's the second alternative. Interest will be paid out of the 9 million otherwise available to pay dividend. So interest will be paid out of the 9 million. So if interest is paid out of the 9 million, it means that the dividend payable will be lesser than 9 million because of interest payments. So back to the requirements. calculate, we want to calculate the value per share, value per share. Let's go back to the notes. So calculation of the value per share, that's share price. Now, the company is an all equity finance company, so the company will not be paying interest. But if the 24 million will be financed by borrowing, and the interest rate is 7.5%, how much interest will the company be paying annually? So the annual, excuse me, the annual interest will be 24 times 7.5. And what will that give? So 24 times 0.75, that will be 1.8. So therefore, the earnings or the profits after, we're told to ignore taxation, so profit after tax, or let me just call it our earnings before tax. Earnings before tax will now be formerly supposed to be 9 million. So 9 million minus 1.8, which is the interest payments that we give 7.2. And the 7.2 will be paid as dividend. The 7.2 equal dividend. Therefore, the market value of equity will be equal to 7.2 all over 0.1. So this will be equal to, the total value now will now be 7.2 million. So if the company remain all equity finance, the number of shares that the company will have will still be 10 million shares. Therefore, the value per share will be equal to 7.2 million all over 10 million shares, which will be equal to 7 naira 20 kobo. So this is the value per share if the company is financed using debt, if the project is financed using debt. You are done with B. C now says write a report to the director. So the first requirement in the report is compare and contrast the right issue and the bond issue method of raising finance. You may refer to the calculation in your answer. Okay, so just basically what we'll be looking at here, when we are comparing equity and debt financing, there are basically one or two things that shareholders will be looking at. First of all, for the equity finance, if right issue is used, the share price will drop from 6. Currently, the cum div share price is 6.63. But if it is financed by a right issue, this price will drop to 6.43. 6 naira 43 kobo. But if debt financing is used, the share price is currently 6.63. So this will be 7 naira 20 kobo. So on this basis, the debt financing is producing a better result. We are looking at the share price. Okay. But let's now look at another indices that you may want to look at, which is the earnings per share. Currently, what is the earnings per share? If a right issue is used, the earnings will be 9 million, which will be paid as dividend divided by 24. So that will be the earnings per share. 9 divided by 24. 9 divided by 24. That's 0.375 kobo. Okay, what if debt finance is used? This will be 7.2 divided by 10. And what will that give? So this will give 0.72 kobo. So on this basis, the debt finance is still better than the equity finance on this basis. Okay. So final thing that shareholders will be looking at is dilution. Dilution in shareholding. Currently, the number of shares in issue is 10 million shares. It's 10 million shares. The number of shares will increase to 14 million. Number of shares will increase to 14 million. 4 million new shares, sorry, and 10 million existing shares. So will this lead to dilution? So that's the final thing that the shareholders will be looking at before deciding on this option. So 10 million formally, and the XZY family has 40%. So they are 40% of 10 million, which is 4 million. So if bond is issued, another bond of 4 million will be issued. So the shareholders will be concerned about control to be sure that they are not going to lose control. So when bond is issued, definitely there won't be loss of control because the bond will be issued to debt holders. And when right issue is also issued, so long as the family also subscribe to the right issue, there won't be loss of control. But where they don't have money to subscribe to the right issue, where they need to sell their rights, then that may lead to a loss in control. Finally, we are asked to look at alternative method of raising equity finance. Replacing refer to the process of selling or issuing new shares of a company to specific investors or institution in a private transaction. The shares are offered to a pre-selected group of investors. These investors could be institutional investors, venture capitalist firm, or private equity firm. It is also important to note that a private placement is subject to regulation in some jurisdiction. So simply put, the private placement or a placement is a private transaction. It's not like a public sale of share. It's a private transaction where shares are sold to specific investors. An offer for sale is done through an investment bank, whereby the investment bank issues a prospectus and sell the shares to the public. While for the public subscription or public offering, the company will issue the prospectus and invite subscription from the public at a fixed price.